Hello, I'm going to um, talk about chapter 24. This is the enterprise risk management. So we want to learn about first objective, learning objective is about use insurance as a risk management tool. And then there are some important things we want to know is the hedging, the approach of hedging, how to use hedging with the forward contracts and the futures, and how to use the hedging with the swaps and options. So there are different types of risks that an enterprise may face. Hazard risk, financial risks, operational risks, and strategic risks. Okay. Um, any organization, they should have their risk management. So they would assess their different risks and they will focus on the most important risk to deal with. Um, so for example, right? So you may want to identify the types of price fluctuations that will impact the firm. Okay, let's say a trucking company, right? For a trucking company, one of their major costs would be their fuel cost, right? Because as mainly there a major significant amount of cost is on the fuel cost. So therefore, the gas price fluctuation that would impact the firm, right? That would impact the firm. So this picture shows that the 2023, how does that average, okay? The average gas price has fluctuated, right? So for trucking companies, this is definitely the risk they want to consider, right? They want to consider. Um, some risks are obvious, others are not, right? Um, for the obvious risks, I was thinking about the earthquake risk, right? You think about in Vancouver Island, right? In this area, um, people keep talking about there is a very big earthquake is coming. Last time there was 100 years ago, there was very significant earthquake happened to Vancouver. Um, so right now there are different earthquakes happening, but the magnitude is very small, right? But people are predicting that it's gonna come, right? A very magnificent, like very high level magnitude earthquake is gonna happen to Vancouver. Okay, so that risk is obvious because people are talking about it, right? But sometimes the risks may not be that obvious, right? So prior to COVID-19, okay, um, how many people were thinking about the supply chain risks due to a global pandemic, right? That's just unheard of, right? Most people won't think that way. Um, when people are opening their door to do business, they would assume that the next day they can still open the door to welcome the customers. But then COVID hit the country, right? And all this isolation, quarantine policies prohibited the business from opening, right? So prior to COVID, that risk um, of the pandemic virus, right, causing the disruptions to all the business, right, to the whole economy, that's just not being talked about, right, not being well thought of, right. So you can see, right, some risks are obvious, others are more like a black swan, right, black swan. So most of the swan are white color, but occasionally it's very rare you're going to see a black swan, right? That's what they're talking about. This is the hidden risk that was there, but people just don't think until it showed up, right? Um, some risks may offset each other. Okay, so companies may have different risks, right? But sometimes the risks offset each other. So you don't have to focus on each individual risk. You actually taking the corporate risk as a profile, right? Portfolio. So, for example, company may face a broad economic risk if the economy underwent a recession, right? Then people don't have money. Then obviously that's going to affect their revenue, right? So if that risk is there, okay, if that risk is increased, right? But guess what? There is also a different risk called the employee turnover risk, right? So nowadays, companies spend a lot of money training employees to do their work, right? Nowadays, it's really hard to find the good employees and to retain them, right? So if your, let's say, key employee, right, or many good employees left the corporation, that's going to be cause quite a bit bigger disruption, right? Cost the company lots of money, lots of dollars, right? So the employee turnover risk is also a risk. But the funny thing is, these two risks can offset each other, right? When the economy is not doing well, right? That means it's really hard to find a job elsewhere. So therefore, right, the employees are most likely to stay with the same employer, right? Because if they left one employer, they have they don't have a good chance, or maybe they have lower chance to find the next employer. So therefore, you think about the risk of the economic recession. If that's high, that's a bad news, right? But then, if that happen, if the economic recession risk is higher, the employee turnover risk will be lower, right? So you can see that two risks, they go to two opposite direction. One risk going up, the other risk going down, right? Vice versa. Okay, so we do not only when we do the risk management, we don't focus only on one risk. It has to be taken the corporation the full picture as a portfolio. We want to consider the portfolio of the risks. You can also need to be aware of the cost and the benefit analysis, right? So for sure, addressing risks is a good thing, right? It's beneficial to reduce or eliminate the risks, right? But at what cost, right? So there's a clear benefit, but at what cost? So you can see in this picture, when you park your bicycle unattended, there is always a risk that these bikes will be stolen, right? So to address that risks, look at this effort, right? Look at that effort. Um, yeah, I think this effort will make the thief despair, right? Despair. It's just, I don't know how can they steal these two bags, but the cost is very high, right? How many locks they installed, right? Yeah. So you have to always be aware of the cost side when you trying to consider the risk management. Risk profile. Risk profiles are a useful tool for determining the relevant impact of different types of risk. So it's kind of like you draw a picture, right, to understand what the risk is like. So we're going to cover the different topics: insurance, managing financial risk, hedging with forward contracts, hedging with future contracts, hedging with swap contracts, hedging with option contracts. There are different types of insurance: property insurance, commercial liability insurance, business interruption insurance, key personnel insurance. Okay, so this type of insurance definitely will help address certain risks, right? Let's say an organization have a key personnel. That personnel is the key success factor, right? We want to make sure that we are protected, right, against the risk some bad things happen to that key personnel, right? So those are, important. Um, Hygiene. Hygiene, okay, let's see here. So hedging reduce the firm's exposure to price or rates fluctuation, right? So for international companies, they are dealing business across different nations, right? So they are facing that exchange rate fluctuation, right? Like I mentioned, the trucking companies, they are facing that gas price fluctuation, right? So the hedging is the way to reduce firms' exposure to a price or rate fluctuation. Okay, that's hedging. Derivative, what's derivative? Derivative is a financial asset that represents a claim to another asset. It derives its value from the other asset. Okay, so on the financial market, there are different financial assets, right? So you think about investment into the stocks, investment into the bond, right? But there are some instruments will derive the value from other asset. Okay, those are other derivatives. Instruments have been developed to hedge the following types of volatility. So, for example, interest rate, exchange rate, and commodity price. Okay. So this picture is a risk profile, right? This is actually a risk profile for a wheat grower, right? Wheat grower. You can see the horizontal axis is the price, the change of the price, okay? Delta P, so that's a change of price in the wheat. And the vertical axis is about the value of the company, okay? So you can see that if the price increase, that means the change is positive. That means it fall to the right side, okay? And then the value go up, okay, of the company. So if you are a wheat grower, definitely you hope, you wish your wheat will be sold at a higher price. The higher the price, the more you get, the you obtain more value from for the company, right? So you can see that to the right side, right, divided by the middle line. So those means the price increase. Okay. To the left side, that means it's a negative. The change is a negative, means price decreased, right? The more price decreased, the value of the company decreased more, right? So you can see that's kind of the risk profile. So basically, that's a basic tool for identifying, measuring exposure to risk. Okay, it shows the relationship between the change in price and the change in firm value. And the slope of the line, if the slope is steeper, that means the risk exposure is greater. Okay, so if the risk is greater, if that slope, right, is steeper, that means the value of the corporation is more sensitive to the changes in the price. Okay. Okay, so this we just talked about, this is the wheat grower, and now this is the risk profile for the risk for the buyer. Okay, so you almost think about you have a buyer, you have a grower, right? So buyer pay money to buy from the grower, right? So this is kind of a zero-sum game, right? So these are the two parties in a business transaction, right? If one party is gain, the other party is losing, right? So between in this transaction, there can be only one winner, right? In terms of that. So for For a buyer, okay, they are hoping that the price will decrease, right? So for the buyer, they are hoping the price will be decreasing. Okay. So if the price decreased, okay, then the value increased. Okay. So the unexpected increase in the wheat price that will decrease the value of the firm. Okay. So you are buying, right? So you are paying the money. If the price is going up, you have to pay more. That means the firm value will decrease. Okay, so the grower wants the price to be higher, right? The higher the better, right? But the buyer would be the opposite because this is a transaction between them, right? So the buyer wants to spend less money, right? So therefore, price increase is a good news to the grower, but it's a bad news to the seller, right? So you can see that risk profile is the opposite, right? Because they are the opposite side of the one party, right? So you can see this risk profile is more like crossing upward, right? From left to right, but the wheat buyer, that it's the opposite direction. So from the left to right, it's downward. Right? Reducing risk exposure. Okay. So the goal of the hedging is to lessen the slope of the risk profile, right? Because if the slope is steeper, it's the risk is higher. So therefore, you want flatten out, right? Flatten out through hedging, right? The hedging will not normally reduce the risk completely, right? Uh, because only price risk can be hedged, right? You can only hedge the price, but the quantity risk, you are not able to hedge it. So for example, the supply, right, of the wheat, how many wheat can be supplied to the market, right? That's hard. And then you may not want to reduce the risk completely because sometimes you want to take some risk, right? Because no risk, no return, right? You have known that, right? Risk is associated with reward, right? If you don't want to take risk, there's no reward, right? So you do not want to completely reduce the risk, because you could miss out the good outcomes, right? If things turned out in the way favor you. Okay, timing, short run exposure, transaction exposure can be managed in different ways. Long run exposure, economic exposure, it's almost very impossible to hedge. The company has to be flexible, adaptable to any changes in the business climate. Okay, so you could, in different ways, you could manage a short run risk exposure. Okay, but for the long run, it requires more effort. Okay, in terms of the company need to be more flexible, adaptable to permanent changes. Forward contracts. Forward contract is a contract where two parties agree on the price of an asset today to be delivered and paid for some future days. Okay, so the two parties, they are going to you know exchange, they are going to do a business, right, at a future date, but instead of waiting until the future date to know the price, they want to predetermine the price, set the price fixed today. Okay, so that's called a forward contract. So they define a future price for a transaction on the future. Forward contracts are legally binding on both parties. Okay, so it has the legal implication, enforcement. They can be tailored to meet the needs of both parties and can be quite large in size. Okay, maybe one party doesn't like the risk, but the other party wants the risk, right? So eventually they can make a deal. It will be good for both, right? Because they are negotiated contracts and there's no exchange of cash initially, they are usually limited to large and credit-worthy corporations, right? So it's interesting you can enter into a contract, but then some people just broke their promise. They walk away from the contract, right? That's called the credit risk, right? So is the other party credible, right? Can they deliver on the promises written in the contract, right? Even you have the best contract written, you think you are able to hedge the risk, but the credit risk is that the other party does not deliver. Positions, the long positions, when we say the long position, that's the buyer, right? The buyer agrees to buy the asset at the future date. Short position, they agree to sell the asset at a future date. So that's from the seller perspective. Payoff profiles for forward contract. Payoff, basically that's kind of your outcome, right? Your outcome. It's a forward contract. Okay. Okay. So for the buyer, they set up a price, right, for a future date. Okay. And it only helps when the price go up, right? So you don't for a buyer for the forward contract, right? As a buyer, I'm really concerned that the price will going through the roof. Right? So instead of taking the risk, I'm saying, you know what? Right now the price is $20. If I'm thinking it's going to be 100, I'm going to enter a forward contract with the parties paying $30 on that day, right? The other party probably think the price will be going down, right? You are so scared, you are concerned the price will go up, and the other party probably think, the price might even drop, right? So then you guys can agree that you are going to buy at $30 in the future, right? So this contract is only helping you when the price is going up, right? From the buyer's perspective. The higher the price going up, right? That contract help you save more money, right? So that's the picture to the left. From the buyer's perspective, a forward contract will help the buyer increase the value of the firm, okay, if the price increased. If the price dropped to $10, right, and at the market value on the transaction date and on the contract, even though the market value on that date is 10, you have to pay 30, right? So therefore, you are losing the value, right? So from the buyer's perspective, you agreed with the future price. It's to the benefit of the buyer only if the price going up. So the seller would be the opposite, right? You can see that the right picture showing the seller's perspective, and they should be exactly the opposite, right? So from seller's perspective, the seller hopes the price will drop, right? Because the price drop and the buyer still pay at a higher price. That's the time the seller actually gained, right? So if you see, take a look at that picture, the right picture, you can see that when the price change is negative, okay, the value is positive. Okay, so from the seller's perspective, is exactly the opposite of the buyer's perspective. The buyer wants the price going up. The more positive, the better. And the seller's perspective is hoping the price will go down, right? Okay, so it's very similar to think about when we buy the house, right? I purchased the house in 2020. Okay, we made a deal. The contract was signed by both parties about September of the year, right? We agreed at the price, okay, and the possession date is actually November, so 2 months later, right? So that's just very typical, right? When you are buying a house, selling a house, you first agreed, right? There's the agreement, there's a date, you agreed on a price, and you signed, right? But the legal possession date is going to take a little bit longer because people need to make plans, right? They can't move out of the house right away, right? They have to maybe buy their own house or find their another place, move out, right? Clean up the house. It's going to take some time. So it happened to my case that since I purchased my house, the market, if you guys remember, this is the beginning of the COVID. After I purchased my house, the the housing market took off in the Vancouver area, right? It's so crazy. In 2 months, I think the price was up like for $100,000 or $200,000, right? Um, so it's good for me, right? As a buyer, from my perspective, I agreed to pay this price, but on the possession date, the price is already like $200,000 higher the market value, right? And it's sad for the seller, right, pre-owner, but they have to honor that contract, right? They have to sell. They can't say, I don't want to sell the house to you now, right? Because that price on the contract does not reflect the current value. The current value is much higher, right? People having bid wars, Well, that's too bad, right? Because we already have a contract. 2 months ago, we agreed at the price, right? So this is a time as a buyer I'm really happy, right? Because uh, after we agreed on a price, the price went up, right, on the transaction date, right? But it's a risk, right? It could go the other way, right? It could all go the opposite way. After we enter the contract, I agree to pay a price. Maybe 2 months later, the market slumped, right? So the price dropped significantly, right? It's just the risk, right? So you can see as a buyer, I prefer price go up, right? So I want to have when delta P is positive, my value is positive. Okay. So basically, this is my favorite area, right? So this is my favorite area. As a buyer of the house, I want the price. This is the change of price, right? I want a price going up, right? So that's the price on the transaction date minus the price of the contract on the contract, right? If it's higher, the price is increasing, that's good for me. But the seller is sad, right? The seller is at a losing position. So what seller want is the seller want the price to be dropped. Hedging with forwards. So you entering into a forward contract can virtually eliminate the price risk, okay? But it does not completely eliminate risk because both parties still face credit risk. Is the other party credible, right? I have this contract with the seller on the house, right? What if he or she, the seller pre-owner, decided not to honor the contract, right? There's always the credit risk. Since it's limited price risk, it prevents the firm from benefiting if the price move in the company's favor. Okay, so if you completely eliminate the price risk, it prevents the firm from benefiting if the price move in the company's favor. The firm also has to spend some time or money evaluating the credit risk of the counterparty. Forward contracts are primarily used to hedge exchange risk, okay, exchange rate risk. So if you want to enter into a forward contract, you need to find another party, right? Is that party trustworthy? You have to spend time, right, money to make sure that the risk is low, that the other party is trustworthy. And this contract is primarily used to hedge the exchange rate risk. Exchange rate risk. Okay. Okay, so if you can take a look at that dashed blue line, right? The dashed blue line. Okay, so the dashed blue line is the risk profile. Okay, the risk profile. The risk, if the price increase, the value decrease. Okay, so that's the risk. The risk is on they are considering if the risk is going up, the price is going up, the value will be going down, right? So therefore, I'm hedging on a price. Okay, I'm hedging on a price so that there's no risk. Okay, there's no risk. So what happened is when there's no risk, that means it's a flat line, right? So it doesn't matter how your price change, your value doesn't change, right? So it doesn't matter how this horizontal change, your vertical value doesn't change. So that's a flat line. That's the risk zero, right? That's the time you eliminate risk. Okay. So in the picture, okay, in the picture, this line is the resulting exposure, right? So the blue line, the blue dashed line, that's the risk profile without forward contracts. So if you don't have the hedging with forward contract, the blue dashed line is your risk profile. That means your as price going up, you are losing money. Okay. But now I want to achieve a zero risk. So when price going up, my value doesn't change. Right? So to do that, you have to use a forward contract. Okay, you have to use a forward contract so that you are paying a fixed amount of value, right? Fixed amount of value. So you don't care how the price change, right? Because it's not gonna affect the money you pay, right? Because you agreed to pay a fixed price, so that is the one affecting the value of your corporation. But the price change, the market price change will not affect you, right? That's why you use that forward contract. So you can see the red line is the payoff, right? The price increase, the more price increase, the higher the payoff, right? Because essentially the amount of payoff is actually offset the amount of loss if there were no forward contract. So basically, if you think about the horizontal line, the black line, this horizontal line, the black line is like a surface. The dash the blue line and the red line, they are mirrored, right? They are mirrored um, along the horizontal axis, right? Future contracts. So what's the we just mentioned about forward contracts, right? Forward contracts. What is the future contracts? It's the same profile as the forward contract. The future contract traded publicly on organized security exchange. So this is the public exchange, right? A forward contract can be just the two like parties they entered into agreement, right? But for future contracts, right, this one, the market is much broader. There are more participants, right? It's actually traded publicly. You have to have an upfront cash payment. That's called a margin. That amount is very small relatively to the contract value. Okay, and the that margin, okay, is changing on a daily basis, right? On a daily basis, depending on the market. Clearinghouse guarantees performance on all contracts. So you have kind of a middle guy, the clearinghouse. They will make sure that the contracts will be honored. So you are essentially eliminating that credit risk, right? Because all the participants on the market, right? They are subject to the clearinghouse. Right? So the clearinghouse and the margin requirements, they virtually eliminated the credit risk. Future quotes. So the contract size is important when determining the daily gain and losses for marking to the market. So the open price, daily high, daily low, settlement price, change from the previous settlement price, open interest. Those will be all the terminologies that you would see used for the futures. Okay, we're gonna see what I mean. The change in settlement price times the contract size will determine the gain or loss for the day, right? So if you know the settlement price changes, that's the change in the price, times the contract size. So that's your gain and loss. For the buyer, okay, for the buyer, they want price increase, right? So that's why the reason they want to buy. They buy, they see the future, they see the price will go up, right? So increase in the price will lead to a gain for the buyer, and it will be a loss for the seller. What is open interest? Open interest is how many contracts are currently outstanding. Hedging these futures, the risk reduction capabilities of futures is similar to that of forwards. The margin requirement and the marking to market require upfront cash outflow and liquidity to meet any margin costs that may occur. So for forward contracts, there's no requirement for the cash, right, upfront payment, but for futures, this is a requirement. Future contracts are standardized, so the firm may not be able to hedge the exact quantity, quality, or delivery date it desires. So I guess forward contract probably are more flexible. It's just negotiated between two parties, right? But the future contracts, they are dealing with like many potential participants, right? So they has to be standardized. Therefore, allows less flexibility in terms of the terms of that contract. Future contracts are available on a wide range of physical assets debt contracts, currencies, and equities. So we mentioned the forward contracts are mostly used for hedging on the exchange rate risk, right? But I believe the futures contracts, they are more broader, right? They are broader. Crossing hedging, hedging asset with contracts written on closely related but not identical asset. This is just the concept, cross hedging. Basis is risk. When cross hedging, the risk that the future prices does not move directly with the cash price of the hedged asset. Now let's talk about hedging with swap contracts. So what's the swaps? A long-term agreement between two parties to exchange or swap cash flows at the specific times based on specified relationship. So you talk about on a day, on that day, you are going to exchange cash flows, right? Depending on some unknowns, right? So for example, on that day, I will give you 5% of interest. On that day, you give me a prime plus 1%, right? So it's interesting that trading, it's really depending on that unknown variable, right? So if the interest rate is floating, right, not often it's the prime rate plus a certain percentage. So you could, if you are more comfortable with floating rate, right? So you just want to pay floating rate, but you receive a fixed rate, right? So the idea is it's a cash flow exchange, right? How much you pay me, how much you give me, okay? But it won't be certain, right? It doesn't make sense that you give me $5, I give you $5, right? That won't be a transaction. There's no benefit. Why would they do that? The reason why they have the swap contract is the uncertainty, right? Uncertainty. So it's a long-term agreement, right? It's a long-term agreement between two parties to exchange swaps cash flow at specific times based on specified relationships. This can be viewed as a series of forward contracts, not just one contract, because it's long-term relationship, right? Generally limited to large, credible, credit-worthy institution or companies. Okay. Types of swaps, interest rate swaps. Okay. So this obviously dealing with the interest rate change, right? So that's the net cash flow is exchanged based on interest rate. Currency swaps. Okay. So this one is the two currencies are swapped based on specified exchange rates or foreign versus domestic interest rates, right? So exchange rate, right? So that kind of connecting to the current swap. Commodity swaps, the fixed quantity of a specified commodity are exchanged at a fixed time in the future. So you exchange commodity, okay? So here's an example. So consider that company A issued $10 million in 2-year bond that have a variable interest rate of the London Interbank Offered Rate, LIBOR, plus 1%. So this is going to be a variable interest rate hinged on the LIBOR. Say the LIBOR is 2%. Since the company is worried the interest rate may rise, it finds company B that agrees to pay company A the LIBOR annual rate plus 1% for 2 years on the notional principal of 10 million. In exchange, company A pay company B a fixed rate of 4% on a notional value of 10 million for 2 years. If interest rates rise significantly, company A will benefit. Conversely, company B will stand to benefit if interest rates stay flat or fall. So basically, the company A, they issued bond, right? This bond have variable interest rate of LIBOR plus 1%. So this is the bond, okay? They issued, this is their liability, this is their debt, and they're going to pay the interest at a variable interest rate, LIBOR plus 1%. So A doesn't like the risk because this is the money they're paying. If interest is up, they are going to pay a lot of more interest, right? So the company doesn't like that risk. So the company won't have uncertainty. They want to pay a fixed rate, 4%. Okay. So right now, the LIBOR is 2%, plus 1%, that's 3%, right? So company A now is paying 3%, but the company is concerned in the near future, the interest rate is going up, right? So therefore, they want to use a swap to kind of have it fixed at 4%, right? The other party may not worry about the interest rate going up. They think interest rate will be going down, right? So you can see the two parties, they have different opinions, opposite opinions about the future market movement. Therefore, they are able to agree on a contract. It's kind of like a gambler, right? Two fighters, they're fighting. Some people bid on fighter A, other people bid on fighter B, right? And depending on who is winning, they may either win money or lose money, right? It's kind of a similar idea, right? There's uncertainty, but people see differently, right? Some audience think fighter A is the better one, right? Fighter A will win, and some other audience think fighter B is going to win, right? So you can see it's only because the market have different opinions there can be transactions, right? If everyone think the price will go up, nobody will buy, right? Right? If everything think price will go down, nobody will buy. There'll be no trading, no transaction, right? It's only when people have different opinions, right? So this is the idea. Company A thinks interest rate is going up. Even right now it's 3%. Maybe in the future that interest rate will going through the roof. Company B, they think right now it's 3%. Interest rate will stay, and all interest rates will drop. So therefore, company B will accept a 4%. Okay. So A passed that risk to B, right? So A passed that floating interest rate risk to B. So now B is the person paying A that floating rate, LIBOR plus 1%. So A can use the payment from B to pay their investors, right? In the same time, A is paying B a fixed rate 4%. Okay. So that's kind of the swamp. So A is happy, right? Because the risk is passed to B. For that risk reduction, he has to incur some cost. What's the cost? The cost would be the 3% now, he's paying 4%, the actual 1%, right? So let's consider this example. Company A can borrow from bank at 8% fixed rate or LIBOR 1% floating. And the company A borrowed a fixed interest rate 8%. Company B can borrow from bank at 9.5 fixed rate or a floating LIBOR at 0.5%, and company B goes with the floating option, LIBOR plus 0.5%. But company A prefer floating. So although company A, they borrowed fixed, But company A is actually prefer floating. And the company B is opposite. Although company B borrows floating, but company B prefer fixed. Okay. So that's the interesting part, how I'm going to show you the swamp contract can actually benefit company A and company B, and also a middle guy, the swamp dealer. Okay. So if you have one transaction, can benefit all the parties, right? That's a great transaction. Right? Okay, so by entering into this a swamp agreement, both A and B are better off than they would be borrowing from the bank. The swamp dealer makes 0.5%. I'm going to show you why this is the case. Okay, why this is the case. Okay, so we know company A borrowed from the bank at a fixed 8.0%. Okay. And A entered into a swamp contract with the dealer. A will pay a floating LIBOR plus 0.5% to the swamp contract. Okay. So A will pay the swamp dealer a floating LIBOR plus 0.5%. And in return, company A will receive 8.5%. Okay. So what is the net the company A is paying? Company A received 8.5%. Okay. And he's going to use that to pay the 8% he borrowed. Okay. And then company also need to pay the swamp dealer LIBOR plus 0.5%. So when I consider, okay, what I get, let me show you. I use a different color. So I received 8.5% from the dealer. So that's my 8.5%. But company borrowed from the bank 8.0%. So he has to pay the bank minus 8%. He also need to pay the swamp dealer, right? He get 8.5%. Now there's no free lunch, right? He doesn't get 8.5 from the dealer for nothing. So he has to pay a floating LIBOR plus 0.5. So when I considered what received minus what paid, that's the net paid. So the net paid is LIBOR. Will A enter in this contract? The answer is yes. Why? Because if A borrowed floating from the bank directly, A has to pay a LIBOR 1% plus 1%. Here, through that swamp, A is only paying LIBOR. So A saved 1%. So A is better off, right? A is better off. If A borrowed directly floating from the bank, he has to pay LIBOR plus 1%. But through the swamp, A is able to borrow, is able to pay, right? The net pay for A is LIBOR. So there is a 1% saving, right? Compared to borrowing from the bank. Okay, now let's take a look at a company B. So company B, okay, they borrowed at a floating, okay, although company B wants fixed rate, but he borrowed a floating. The floating is LIBOR plus 0.5%. Okay, so some people may ask, so why they borrowed at a floating, but they want a fixed rate, right? So if you take a look at this example, company B, the fixed rate is 9.5%. This is very high comparing to the fixed rate 8% for company A, right? And you take a look at the fixed That's the fixed rate. Take a look at the floating rate for company B, right? So company B's floating rate is LIBOR plus 0.5%. It's cheaper than company A, right? So company A have a relatively cheaper fixed rate, 8%. But company B has a relatively cheaper floating rate, LIBOR plus 0.5%. This is why they went into this contract, right? Because of the rate is better, but they don't like the term, right? Company A doesn't like it fixed. Company A wants to take risk. Company wants to have a floating. Company B don't like floating, even though they entered into the contract as floating. So company B wants to have a fixed, okay, a fixed rate. So company A borrowed at floating. So that's the LIBOR plus 0.5%. And then B entered into a swap contract with the dealer. The B will pay because B wants to have a fixed rate. So he wants to pay a fixed 9% and receive the floating LIBOR plus 0.5% to cover the borrowing from the bank. Right? In that case, what is net, right? His net is he receives from the swamp LIBOR plus 0.5%. This is from the swamp received. A minus he's paying back to the bank, and the minus he's paying to the dealer. So the net cost for company B is a fixed 9% interest rate. If company B wants to borrow from the bank directly, he has to pay 9.5%. So right now, B is actually using 9%. That's 0.5% better than he would otherwise obtained the fixed rate from the bank. So by entering into the swamp agreement, both A, B are better off, and the swamp dealer is also better off. So for the swamp dealer, when he's dealing A, he pay 8.5, receives LIBOR 0.5%. When the same swamp dealer is dealing with B, he is paying LIBOR plus 1.5%, but he receives 9%. So take a look, right? So when he's dealing with A, the swamp dealer is paying 8.5. When he is dealing with B, he receives 9%. So that's the 0.5% benefit for swamp dealer. Okay. So let's take a look at together. So by entering into this swamp agreement, A is 1% better, right? So A wants to have a floating contract, right? And the cost after the swamp contract is LIBOR. If A got this floating from the bank, that rate is LIBOR plus 1%. So that's an achievement of saving 1%. For B, B wants to have fixed rate. Through the swamp, B effectively achieved a 9% fixed rate. If he obtained the fixed rate from the bank, that fixed rate is 9.5%. So that's a saving of 0.5%. And the swamped dealer is better 0.5%. So when I add them up, so 1% for A, 0.5% for B, and 0.5% for the swamp dealer. So together, that's a total saving of 2%, right? So where is this 2% saving coming from? Okay, you want to ask yourself that, right? So how come there's a room for creating the saving? Well, the fixed rate saving is 1.5%. So A can get 8% saving, fixed rate, and B can get 9.5%, right? So you think about A can get 8%, and B can get 9.5%. So right away, there's a difference of 1.5%, right? A can get LIBOR plus 1% floating, but B can get cheaper, LIBOR plus 0.5%. So B can get 0.5% cheaper than A. So right away, there is a 0.5. So there is 1.5 cheaper for A than B, and 0.5 on the floating for B than A. So when they work together, that room is created, 1.5% plus 5.5%. Together, that's the 2%, right? So the reason why they're better off is because that three parties work together to take advantage of the um, the the strength of each party. A's strength is A get a cheaper fixed rate, 1.5% cheaper. B company's strength is get a 0.5% better floating rate. So together there is the 2%. So then they reallocate the 2% among the three parties. 1% for A, 0.5% for B, and 0.5% for the swamp. Okay, that's what happened. They could allocate it evenly, right? It doesn't have to be this number, right? You probably can figure it out. How can they allocate it evenly, right? Option contracts. Option contracts. So the right, but not the obligation. Okay, to buy or sell an asset for set price on or before a specified date. So the option contracts is a right. I have the right to do something, but I'm not responsible for doing it. So I don't have to do it. I have the right to do it. Okay. So what would be an option contract? So I'm thinking, let's say I'm a teacher. Okay. I'm a teacher. You are a student. Okay. And you want to enter into an option contract with me. Okay. So you will say, hey, teacher, I'm going to pay you $1,000 to enter into an option contract. Okay. What is the option contract? Okay. The option contract would be my right to receive a grade of A plus in the for this course. Okay. So the is the right to have a grade, right? The right to have a grade of A plus for this course, right? Um, okay, so what happened is that you don't have to exercise. Okay, sorry, I should not go that extreme. A better example would be the right of achieve a B, right? A right to achieve a letter B, okay? Without considering the mark, not A plus. If it is A plus, everyone will just to use the option, right? Because you cannot get a better result than that. So let's say the option to allow the student to get a lighter grade, lighter grade of um, A, right? Let's say get a lighter grade of B plus, like B plus, okay? So at the end of the day, the student did really well. The student by himself, he got an A plus, right? So the student don't have to exercise this option. The student don't have to say, well, now I'm obligated to tell you that my grade is B plus, right? No, So if you get better outcome, you go with your own better outcome, right? But let's say the student get a C minus, right? And then he would access the option saying, I want to access my option to get a B plus, right? So it's the right, not obligation, right? So you have the right to use that option, but you are not obligated to use the option. So the right but not obligation to buy or sell an asset for a set price on or before a specified date. So when we say call, this is a right. This is a right to buy an asset. When we say put, this is the right to sell an asset. Okay. So seller's obligation. So the buyer has the right to access the option, but the seller is obligated. If the buyer has the right to buy, right? Okay, to access the option, the buyer cannot say no, 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 don't exercise the option. I change my mind. No, you don't. You have you the seller. So the buyer has the right. The seller has the obligation. Okay. For call, remember call is the right to buy. The option writer is obligated to sell the asset if the option is exercised. Okay. Put is the right to buy. Sorry, put is the right to sell. So option writer is obligated to buy the asset if the option is exercised. So one party say they have the right to buy, the other party has to sell. One party has the right to sell, the other party has to buy. Okay, so that's the difference between call and put. So unlike forwards and futures, options allow the buyer to hedge their downside risk, but still participate in the upside potential. So remember, I just mentioned that when you are using forwards and the futures, right? When you're trying to reduce your risk, right? Um, you are not only reducing your downward risk, right? Downside risk. That's when the bad things happened. You are also reducing, right, the risk of good things happen to you. Right? You have a downside risk. You also have upside risk. Right? So if you reduce the risk, you are reducing the risk on both sides, right? So if you reduce the chances of the bad things happen to you, you are also reduces the chances of the good things to happen to you, right? So that's what the forwards and the futures work, right? But option, right? They allow the buyer to address their downside risk, right? When things are not going the way, right? Then you don't have to exercise the option. You leave it alone. Just treat it as nothing happened, right? But if okay, if it's the downward, if things happen better to you, then that's the time you exercise the option. Once everything's good, leave it alone. So in my example, okay, so we have an option of letter B, right? So if that contract, you have an option contract, and you pay money, you say, I want to get a grade of B, right? A B plus. Okay. This is useful, right? It's only when your actual grade is C minus. If your actual result is C minus, right? You can bump it to B plus, right? So this is your downward risk, right? The risk that you are not achieving that set up standard B plus. then you can use it, right? With the option good. When the outcomes is not as good as the one set at the option contract, then you bump it up, right? So in the sense that you address that risk, you will do worse than B plus, right? At least now you are guaranteed you can get a B plus. But then let's say you scored A, your actual result is A, right? Because you don't have obligation to exercise this option, right? So then you just don't exercise the option, you still get A, right? So you see, you actually reduced the risk. You don't do good well, but you are still able to keep, right, the potential of doing really well. Okay, so now let's talk about the calls. Call, remember what's the call? You English is my second language. When I say cow, I was thinking about the animals in the dairy farm, right? So cow, cows, okay? So the right to buy the eyesight. For the buyer, so the pictures on this is the option payoff, right? Payoff means their outcome. Okay, for the buyer, okay, the buyer of the call option, right? So what happened is, if you take a look at that picture on the left side, okay, you notice that the payoff is zero, right? This option does not give you any payoff. That means that option is useless, right? It doesn't help you. So when this option doesn't help you, right? Okay, when does that option doesn't help you? Okay, so the call is the right to buy the eyesight, right? Okay, to buy the eyesight. If the price decreased, well, you don't want to use that option, right? Because your on option, the option price is here, right? When the price decreased, the actual price is below your option price. So why, as a buyer, why would you access that option, right? So you don't access that option. Does that make sense? So you set up the option price here. Only when the price is higher, right? As a buyer, you want to buy at low. That's the time you want to access the option. As a buyer, you want to buy at a lower price. If the price is coming down, lower than the option price, you don't access the option, right? You use the actual price. So in this case, as a buyer, in terms of the right to buy of the call, okay, when price decreased, that option doesn't help you at all. That option doesn't help you to make any money, right? So therefore, it's zero. So when the price is decreased, right? This side, the left side is the price decrease side. You can see that the value doesn't change, right? It's zero. Value change is zero because that option didn't help you at all. The payoff is zero. Okay, however, when the price increased, right? The price increased. As a buyer, I don't want to pay that high price. I'm gonna exercise my option, right? So the exercised price will be lower than the current market value. So that's the time my payoff will increase, right? The more price increased, the payoff, the more price increased, the payoff will be higher, right? Well, the seller would be in the opposite direction, right? You think about the buyer and the seller. One person gain, the other person will lose, right? So we're look at this picture, right? So they should be the opposite, right? When buyers is gaining, the sellers should be losing, right? So you can take a look. The left side is the same, but the right side when buyer is gaining, going upward, the seller is losing, going downward, right? Going down means the value is decreasing, right? Because the delta V, right? The delta V is the change in value, right? If the change is negative, that means it's losing value. Okay, now let's talk about the put. We just talked about call, right? So put is the right to sell the asset. The right to sell the asset. Okay. So the left picture is from the buyer's perspective, the buyer of the put, right? So don't be confused. The buyer, we are saying the buyer of the put. And the right to sell is just to sell an asset, right? So buy put, sell asset, right? So don't be confused on that. So as a buyer of the put, right, there's a price on the right to sell, right? The right to sell. If the price is going down, right? If the price is going down, no, I will say the other way, right? If the price going up, okay, you want to sell, right? It's a good news to you, right? It's a good news to you because you want to sell it, right? So the price is going up, you don't need this option, right? This option to help you to sell the asset at a certain price. If the price is going up higher than the option price, that option is useless, right? Because the market price is higher than the option price. You want to sell it high as a seller, right? So therefore, that option is useless. So when the price is going up, then the option doesn't help you. So the option payoff is zero. Okay. But when the price decrease, right? You want to sell it at a better price, at the option price, that's the time you use it. So that's what we talk about on this side. When the price decrease, it's gonna create value for the buyer of the put, right? So again, you can see that on the right side is the seller's perspective, right? This is the one transaction of two sides. If buyer is gaining, seller is losing, right? So you can see it's the opposite. The buyer is going this direction with higher value, and the seller is going this direction with lower value. Okay, so that's the payoff of the profile. Okay, so originally, if you do not have the hedging, this is your risk profile, right? Okay, this is your risk profile. You want a price. This is kind of like the grower, wheat grower, right? When price is higher, your value is going up. When price is lower, your value is going down, right? So now the idea is we want to have a put option. Okay, I want to have a put option. If you buy a put option, let's take a look. So this is a put option, right? As a buyer. So if I buy a put option, it gave me the payoff like this shape, right? So the shape is like a open seed, right? Okay, so now here, this green, this red line, dashed line, right? This red dashed line is the put option payoff. We have just seen this option, right? So that's this one. This is the put option. When you buy a put option, this is what it look like, the payoff. Okay. So now the original blue line, right? The original blue line, that's the original blue line like this. The original blue line like this. And then when we use the hedging with the put option, I can add this red. Okay, so you can see, right? This one is negative. This part is downside negative payoff, but the put option will offset that part. So eventually, these two they net each other to make this flat line. Okay, this flat line. So basically, when the blue line, okay, so I will erase this. It's getting a little bit crazy. Okay, I can't see very well. Let me erase everything. Okay, so what I'm saying is now you have this risk profile, right? If you have a put option, the payoff promised is like this. Okay. So now you're going to add these two lines together, right? You're going to add the blue line, which is the original risk profile, and the red line, that's the payoff provided by the option, right? So when you add them up, okay, you will get a green line. Okay, I'm going to use a green color. So this part, red and blue, the red is positive, the blue is negative. When you add them up together, this is 0. Okay, this is 0. And the right side, the red is 0, right? Red is a 0 flat line, and this is the blue. So now the shape should look like this. Okay. So you have no risk now. Your risk is 0 if the price is going down, right? So if your price is going down, the risk is 0 because you can use that option, right? But if your price going up, you can still not use the option, still achieve that upward potential. So you can see the downside risk was addressed, right, to be risk-free, right? But the good risk is still maintained, right? Okay, so hedging commodity price risk with options. Commodity options are generally future options. Exercising a call, remember, call is the right to buy, okay? So the owner of call, since this owner of call, they have the right to buy, they receive a long position. A long position is the position of buyer, right? Because they want to buy, okay? In the future contracts, okay, plus cash equal to the difference between the exercise price and the futures price. So they only exercise the option when they are in a good position, right? When they are making money. So therefore, the owner of a call, they are going to receive money, right? They're going to receive the cash equal to the difference between the exercise price and the future price. So when the future price is higher, right, than the exercise price, right, they are going to get the difference back, right? Because it's only to their benefit when they exercise the option, right? The seller of call, right? The seller of the call receive, because they're the seller, receive a short position seller in the future, right? Contract and pay cash equal to the difference between the exercise price and the future price. So they're the seller, right? So the call option is to buy. Okay. So now the owner of the call, they receive cash, and the seller of the call has to pay the cash. Now, exercising a put, right? The put is the right to sell, right? Put is the right to sell. So the owner, again, right? The owner, when they exercise it, it must be making money. They're gonna receive cash, right? If they had to pay cash, why would they exercise it, right? So the owner of the put, right? So the owner of a put, they want to sell. So they have a seller position, okay? And they will receive the cash, okay? The seller of the put, the seller of the put, they are the seller, they are the buyer, they're gonna receive a long position, right? They are gonna receive a bond percent. They are obligated to buy from the seller because this is the put, the right to sell. And then they will have to pay, right? So remember, the person who exercised the option are the person who benefit from this option. So therefore, they receive the price difference, and the other party will pay for that price difference. Hedging exchange risk, exchange rate risk with option. Okay, so this is used primarily by corporations do business overseas, like international corporations. Okay, so the example would be a Canadian company wants to hedge against a strengthening dollar, right? So if Canadian dollar is going up, they are doing business, let's say in China, right? So they received a lot of Chinese money when they do business. Now they want to bring the money, Chinese money, to Canada. If at that time Canadian dollars is stronger, that means they can convert it lower Canadian dollars, right? So that's kind of a risk they need to hedge, right? So you can buy puts or sell calls on foreign currency. So what's puts? Puts is the right to sell, okay? The right to sell, and the calls is the right to buy, right? When you buy puts on foreign currency, okay, so you have the right to sell. So you are protected if the value falls relative to the dollar, right? So basically, that's this picture. So when you buy puts, okay, if you are the buyer, you buying puts. When the foreign exchange rate fall, right? When the dollar fall, you are able to sell it at a better price. So that therefore you are gaining, right? If the value of the foreign currency fall relatively to the dollar, right? That price is falling. You want to exercise your your puts, right, option, then you can sell at the exercise price. Hedging interest rate risk with option. Okay, so for example, we are saying caps, floors, and collars. So interest rate cap prevents a floating rate from going above a certain level. So you buy a call on interest rate. Okay, so you buy a call on interest rate. That means this is right to buy, right? This is the call is the right to buy. So basically, so the interest rate cap prevents a floating rate from going above a certain level, right? So in the option, right, you are able to set up your price, right? Then you are able to exercise the price if that interest rate is going beyond that set up option price. And then interest rate floor will prevent the floating from going below a certain level. So this is you sell a put on the interest rate. So put is the right to sell, right? Right to sell. So you can sell it at a interest rate floor level. right? So basically, you have a cap, you have a floor, right? So that puts will allow you to sell at the floor, right? And that interest cap, rate cap, will allow you to buy at a cap. Caller is buy a call and sell a put. So you can use the premium received from selling the put, okay, and to help you to offset the cost of buying the call, right? So it's a collar. So you work on both sides. If set up properly, the firm will not have either a cash inflow or outflow associated with this position. So that's good. So you are able to manage that risk. Okay, so that is the chapter 24. It's a lot of information. Sometimes it takes a little bit more time to digest, to think through, right, these relationships, right? So I hope you find the video useful. Okay, take care.